Stocks fell across the board Wednesday with the Dow Jones plummeting more than 800 points. There's a lot of red on this board. The Dow fell nearly 2%. The S&P and NASDAQ both fell around 1.5%. And the sell-off was led by a spike in Treasury yields as investors voiced concerns about the GOP spending bill proposed by President Trump.
All right, let's take a look at the Treasury yields this morning. You do see slightly lower yields, but that 20-year is now at 5.1%, just over that. The 10-year at 4.58, the 5-year at 4.13, and the 2-year above 4% as well. This came after a big jump in yields yesterday, a lousy 20-year bond auction. For more insights and volatility on the bond market right now, what it means for investors.
A 20-year auction. Now, a 20-year maturity for a lot of people in the bond market, not a great maturity. A weak 20-year auction for a lot of people in the bond market, not worth paying attention to. Why was it so important this time around? Is it a reason to sell or an excuse to sell?
What do you call it when the world's largest economy racks up $4 million in debt every single minute just as its biggest creditor pulls the plug? Picture this. The U.S. heads into the second quarter of 2025 expecting $850 billion in cash flow, but only half shows up. At that exact moment, China dumps $1.7 trillion in U.S. Treasuries, sending the dollar into a tailspin and forcing Washington to borrow $514 billion just to keep the lights on. Mortgage rates skyrocket, inflation spikes, allies start bailing, and suddenly U.S. debt isn't the safe bet it used to be. This wasn't a random glitch, it was a global wake-up call. So what happens next? It could rewrite the rules of economic power. The U.S. is now piling on debt at a staggering pace, $4 million every 60 seconds. But that burden got a lot heavier when China started unloading its treasury holdings. Beijing has sold off $1.7 trillion in U.S. bonds, triggering a borrowing frenzy that forced the Treasury to raise $514 billion, a 317% jump from its February forecast. Bloomberg reports this sell-off came after Washington blocked U.S. banks from backing a Chinese EV battery company's $5.3 billion IPO. That move wasn't just about finance. It was a geopolitical jab, and China hit back hard. The dollar plummeted 9%, bond yields spiked, and gold prices soared as investors fled dollar-based assets. Now the U.S. is stuck funding its global strategy with money it doesn't have, while the world wonders if Washington can still afford to call the shot. This all started when J.P. Morgan and Bank of America were ordered to pull out of the Chinese EV battery maker's IPO. That company, tied to China's strategic tech sector and flagged by the Department of Defense as part of its military-industrial complex, wasn't just any firm. The banks faced regulatory heat if they didn't comply, so they walked away. But the cost wasn't just a 0.2% underwriting fee. Reuters says losing access to China's financial ecosystem could cost billions down the line. China didn't just fire off a press release, they liquidated a massive chunk of U.S. debt. Now, Washington's dealing with market chaos and the fallout of turning private banks into pawns in a geopolitical chess game. The timing wasn't random, it was calculated. China slashed its U.S. Treasury holdings to $759 billion in the first quarter of 2025, the lowest since 2016, while boosting its gold reserves to 2,292 tons, marking 5 straight months of increases, per the People's Bank of China. This fits a broader strategy to diversify reserves amid rising U.S.-China tensions. IMF data shows the dollar's share of global reserves fell from 64.7% in 2016 to 57.4% by the third quarter of 2024. Unlike past sell-offs, this wasn't just market noise, it was a deliberate signal. The question now is, can the U.S. keep its economic dominance when its biggest creditor is rewriting the playbook? At the start of the second quarter of 2025, the U.S. Treasury expected a cash pile of $850 billion. Instead, they were left with just $46 billion, less than half of what they planned for. This massive shortfall, made worse by the return of the federal debt ceiling in January, forced the government to borrow way more than expected. A Treasury statement revealed that without this cash collapse, borrowing for the quarter would have been $53 billion lower. So why did officials stick to outdated forecasts when the numbers were clearly crumbling? Bloomberg reported that Wall Street traders were gearing up for a borrowing figure around $255 billion, not the nearly double amount we got. This gap raises serious questions about how fiscal policy is being managed in real time. If the Treasury misjudged its starting point this badly, what else might be off in their financial roadmap? Some analysts, like those at Reuters and IPSLU, hoped President Trump's tariff hikes would boost Treasury revenue and patch budget holes. But early signs point the other way. Take Apple, for example. They're projecting a $900 million hit from tariffs in the second quarter of 2025, and they're already talking about raising iPhone prices. Meanwhile, consumer inflation jumped to 3.4% from 2.2% last quarter, driven by higher import costs. This isn't just a blip, it's a structural squeeze. As imports drop and corporate profits take a hit, tax revenue might not keep up with the growing interest burden from higher bond yields. If tariffs were supposed to stabilize the budget, the data suggests they're tightening the noose instead. Behind every Treasury auction is a family paying more for less. With China pulling back from U.S. debt markets, 10-year Treasury yields have shot past 4.6%, hitting 6% in May 2025. That's pushed mortgage rates to a 15-year high of 7.8%, according to Freddie Mac. Auto loans are now at 9.1%. With student loans averaging 6.6%. Affordability is eroding fast. The Consumer Price Index climbed to 3.4% in the first quarter, up from 2.2%, with food and energy costs leading the charge. That's not just economic friction, it's real-world pain. Bloomberg also noted a 5.1% drop in household purchasing power year over year, hitting middle-income families the hardest as imported essentials get pricier against a weaker dollar. Speaking of which, the dollar's down 9% since China's bond sell-off, and those costs are stacking up. Here's the bigger issue. As Washington scrambles to adjust, it's not foreign investors feeling the heat, it's American consumers. In the first quarter of 2025, foreign investors dumped $317 billion in U.S. assets, the biggest capital flight since 2016, according to Treasury data. Even allies are treading carefully. Saudi Arabia, once a top 10 Treasury holder, slashed its holdings to $126.4 billion, down 22% from mid-2024. This is a wake-up call. The U.S. economy is under pressure, and the ripples of China's pivot are hitting home, literally. Right now, global finance is shifting under our feet, and it's happening faster than most realize. Congress just pushed a bipartisan mandate forcing BlackRock and Vanguard to pull $812 billion out of 220 Chinese companies. That's not just a number, it's a signal that global capital flows are becoming a political battlefield. The fallout? Asian IPOs on U.S. exchanges are cratering. In 2025, only 28% of Asia-based firms chose U.S. listings, a steep drop from 75% just 3 years ago, according to the Wall Street Journal. Meanwhile, Tokyo and Frankfurt are picking up the slack, seeing a surge in listings and bond demand. The U.S. isn't just losing investor confidence, it's losing its grip on global financial trust. Allies are quietly stepping back, and that's harder to spot than outright defiance, but far more dangerous when it snowballs. While Washington leans on debt to flex its geopolitical muscle, Beijing is building off-ramps. In 2026, China will roll out a national credit rating system to sidestep Moody's, S&P, and Fitch. Why? The China Institute of Finance and Industry says these Western agencies have inflated borrowing costs for Chinese state-owned firms by up to 120 basis points, despite stronger fundamentals. At the same time, China's upgrading its domestic payment systems to reduce reliance on SWIFT, the dollar-dominated network vulnerable to U.S. sanctions. And here's a big one. BRICS Pay processed $56.4 billion in transactions in Q1 of 2025 alone, with nearly half in local currencies, per Bloomberg. These aren't small experiments. They're deliberate moves to shield Beijing from Western economic pressure. As more nations gravitate toward China's financial orbit, the real question is, will the US dollar stay the world's currency, or just a regional one propped up by legacy? The Treasury's banking on borrowing $514 billion in Q2 and $554 billion in Q3 to hit a cash balance of $850 billion. But as of mid-May, they're only at $563 billion, up from March's $46 billion, but still 33% short according to their own Monday statement. JP Morgan analysts are sounding alarms, saying the market won't keep ignoring the gap between fiscal promises and reality. Rating agencies like Fitch and S&P Global are also starting to question the U.S. sovereign outlook, warning that the Treasury's cash strategy needs a serious overhaul. If Congress doesn't step up, with BRICS building alternatives, China dumping dollar liabilities, and even allies hedging their bets, the U.S. faces a stark choice: reform its fiscal and foreign policy game plan, or watch its financial dominance get quietly replaced, not by force, but by design. The numbers don't lie. Mortgage rates are climbing, investor confidence is cracking, the global economy is shifting its center of gravity. Beijing's not waiting, BRICS isn't slowing down, and Washington? It's still betting on legacy power to hold it together. But debt clocks don't stop for politics, and markets don't run on nostalgia. So here's the question: what happens if the next Treasury auction flops? What if allies start calling U.S. bonds exposed instead of safe? Drop your thoughts in the comments below, because from interest rate spikes to reserve currency shakeups, every nation, company, and household might soon have to pick a side. Want to stay ahead of this? Hit that subscribe button, tap the bell, and join us as we track whether America's economic leadership unravels or rebuilds. Thanks for watching. Give this video a like.